put it 21. Okay, let's see if it will reach this level.
EU have very little leverage on fish. So what they've tried to do is make an artificial link with trade, say no trade deal unless you surrender on fish. I don't think that's going to work, but I can understand why they're using it. I mean, what the UK is asking for is nothing extraordinary. It's just the normal relationship between two countries, two coastal states that share stocks. So the EU's current relationship with Norway, for example, and another independent coastal state, is exactly what we want. Annual negotiations for a fisheries agreement, access to each other's fleets on negotiated terms, quota shares that reflect the resources in each other's waters. Absolutely normal. It's the EU that's aberrant in this, I think. EU is the outlier on fish.
What about, though, the UK's ability to land a catch in EU countries, Barry? Because it's all very well wanting to increase the size of the UK fishing fleet, but you're going to have somewhere to sell this stuff. Are those two, are they tangled together, if you like, in the same net in this conversation around fishery?
I don't think they are. I mean, as I said, I think it's the EU that's trying to make this artificial linkage. If we didn't have access to, if there was no trade agreement, we would have to trade on WTO.
Position open for Canadian dollar at 131.21. Okay, we are long on this pair.
That benefit from the 5 member states that benefit from the access to UK waters. That leaves a large number of member states that haven't got a fishing interest that depends on access. So I think there's some hard thinking to be done in the European camp. I mean, there are businesses, fishing businesses on both sides of the channel that depend on this trade. You know, there's a demand within the European countries for the resources that are caught in UK waters. There's a big interest in making this thing work. Whether the politics gets in the way is something we just can't really foresee at the moment.
Barry, it's not all about borders and Brexit. Climate change is also an issue that fishermen face, you know, globally. But I wonder what consequences climate change have had in the UK. I know your cod population, for example, is moving north.
That's right. In general, the stocks that we fish have been going in the right direction since about the year 2000. There's a big reduction in fishing pressure, and the stocks have been coming back up. But there are stocks that you're quite right. The scientists tell us that cod is moving northwards by about 12 kilometers a year. And that is causing problems. The concentrations of cod around the Shetland Islands and Iceland and the Barents Sea, less so in the southern North Sea and the Channel, where cod is at the southernmost extent of its distribution range. So climate change, water temperature change is certainly having an effect on the distribution of stocks. Doesn't really impact on the regime that we have, how stocks are shared out, accessed over who fishes, and that's a kind of separate issue.
So these things are changing. In terms of just final question, if I could, on the Brexit negotiations, you want to go to the Norwegian model, Barry, as you've set out, where you get an annual agreement on this fishing relationship. Is there not a risk there then that every year your industry is caught up in the wider politics across the Channel, and that would lead to tension and a lack of predictability?
That's not what happens in the case of the current EU negotiations with Norway. Quota shares tend to settle down. So if they're based on a scientific assessment of what's in each other's waters, quota shares aren't renegotiated every year. And access only really becomes an issue if there's no overall agreement. I mean, if by the end of December there's no agreement between EU and Norway, we don't have access to Norwegian waters, they don't have access to our waters. And that's the picture that we would expect to apply between the EU and the UK. well, from next year.
All right, Barry, thanks very much. Been fascinating talking to you. Barry Thies there, National Federation of Fishermen's Organizations CEO. Up next, are markets underpricing the pandemic impact? We'll put that question to Christine Aquino, who leads our Markets Live team in Europe. This is Bloomberg.
Okay, I'm placing a stop on profit for Canadian dollar at 131.23. Okay, stop on profit placed.
Welcome back to Bloomberg Markets. This is the European Open. It's almost an hour, 53 minutes into the session right now, and we're still looking at these red arrows. You can see the benchmark on top there. That's the Stocks Europe 600 index, down 1/3%. The travel and leisure stocks are the biggest losers, down 1.3%. S&P futures, if you're preparing for the open on Wall Street, are off now 0.5% after the S&P climbed yesterday, as did the Dow, but especially the NASDAQ. So really tech stocks led the gains, but it looks like investors are going to sell and take those profits today. Joining us to discuss more is Christine Aquino, who leads the Markets Live team out of Europe. Christine, it looks like you've got, on the one hand, the big tech rally could have helped us gain today, didn't. In the end, is that because the pandemic? On the other hand, the concerns about COVID are leading us down with the local lockdowns in London, in the UK?
Yeah, Matt, definitely. It looks like concerns about the pandemic are back in the forefront. I think markets did get a stark reminder that we are still in this sort of situation with news of the Johnson & Johnson vaccine trial halt. And that just really serves as a reminder that until there is a vaccine for the virus, there's kind of a natural circuit breaker on any sort of optimism around activity, around economic economic recoveries and all of that, because unless things really do get back to normal and economies get going again in earnest, there's always going to be a natural stop to any sort of optimism. Every time we get any sort of setback on that front, you would expect markets to take that into account as they are today.
And just briefly, Christine, we're looking ahead to the German ZEW data. How useful is that going to be?
Well, it's going to be useful in terms of just gauging the current sentiment for consumers, and of course that feeds into their propensity to go out and spend money or otherwise. And so it would be very helpful in terms of a forward-looking indicator where consumers stand at the moment, what they're thinking about, especially into the winter months, and how likely they are to gear up on activity, or on the flip side, how likely are they to stay indoors again as we are waiting for virus cure.
Christine, thanks very much. Christine Aquino, who leads our Markets Live team here in Europe. That is it for the European Market Open. Stay with Bloomberg TV. Up next, we'll have surveillance, of course. They'll take you through the latest market action. US futures do point modestly to the downside, down by around 0.5%. NASDAQ futures also negative. European stocks down by 0.4% this hour. This is Bloomberg.
Johnson & Johnson halts its COVID-19 vaccine trial after an unexplained illness in a participant. Futures slip. China's rebound, exports and imports rise in a sign of a robust domestic recovery in the world's second largest economy. And there are 3 weeks until the U.S. election. President Trump returns to the campaign trail in Florida.
I'm immune. I feel so powerful. I'll walk into that audience. I'll walk in there. I'll kiss everyone in that audience. I'll kiss the guys and the beautiful women and everybody. I'll just give you a big fat kiss.
President Trump there. Now, welcome to Bloomberg Surveillance. I'm Francine Lacroix here in London. This is what the markets are looking at. Now, we are starting to get a lot of bank earnings. Certainly, they will start in the U.S., and then they'll come thick and fast, and that could move some of the banking stocks. Overall, stocks are dropping, edging lower with U.S. equity futures as investors, again, weighing a potential setback on progress towards a coronavirus vaccine ahead of a really busy period for corporate earnings. Dollar and treasuries advancing. I'm also looking at oil. It's fluctuating after slumping with workers in the U.S. Gulf heading back following Hurricane Delta's landfall, but also Libya taking a major step towards reopening its biggest field. Now let's get straight to the Bloomberg First Word News. Here in London with me is Leanne Gerrans. Hi, Leanne.
Good morning, Francine. Here, UK Prime Minister Boris Johnson has announced bars and pubs will close in the worst-hit parts of England. His top health advisor is warning it won't be enough. Chief Medical Officer Chris Whitty says local authorities will need to take more action to get the virus under control, in some areas significantly more. Crossing over to the US, the confirmation hearing of Supreme Court nominee Amy Coney Barrett descended into a partisan clash over Obamacare, the pandemic, and President Donald Trump. She cast herself as someone who puts personal preference aside, pointing to what she sees as a vital but limited role for federal judges. Barrett says justices are not on the bench to make value judgments. The coronavirus pandemic will cost the U.S. around $16 trillion, 4 times the cost of the Great Recession. That's according to former Treasury Secretary Larry Summers and fellow Harvard economist David Cutler. They arrived at the figure by adding the costs of loss of life and health to the direct economic impact. And Facebook users are consuming twice as much fake news as they did in 2016, according to a report by German Marshall Fund. Engagement with the outlets that repeatedly published false and deceptive content has increased over 100% since 4 years ago. It's the latest evidence that Facebook is struggling to stem the flow of disinformation on its platform. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, China's exports rose for the 4th straight month in September, while imports surged, pointing to further recovery for global trade and a robust domestic rebound. Now, the data indicates that China's relatively rapid return to full production after its own pandemic shutdowns have enabled it to take full advantage of manufacturing reopenings and consumer demand elsewhere. At the same time, the resurgence of the virus in Europe and elsewhere poses a threat to the recovery, as do geopolitical tensions with the U.S. Now, to talk about all of this is Nicolas May. He's sovereign credit analyst in the portfolio management group at PIMCO. Nicola, thank you so much for joining us today. I don't know how you look at the fixed income space overall, but it's always a good barometer when you look at growth overall. If China were anything to go by, is a recovery going to be quicker than expected?
Thanks, Francine. Well, I would say, yeah, the Chinese rebound has been much stronger than elsewhere, and I would say that China is on a path that is probably better than in other places for a couple of reasons. I mean, first of all, China had a pretty effective response to the COVID-19 crisis. They had a very strict lockdown, but then they got cases under control relatively rapidly. And also China is very oriented towards production of goods where there's been high demand. I mean, think about PPE and sanitary products as well as tech production. So, you know, all that glitters is not gold, however. If you look at Chinese consumer spending, for example, the recovery there has been pretty slow. So I don't think we can use China as a barometer for elsewhere. We view a pretty slow recovery, slower than we see in China elsewhere, which actually could end up fueling some geopolitical tensions which are already in place as China tends to do better than others.
So, Nicola, are you thinking about trade wars being back on the horizon? And what does that do to central bank policy, and what does it do to fixed income? Yeah,
I mean, we had a secular forum recently where we talked about next the next 3 to 5 years. And among the key risks, we said China's rise would be one. I mean, I think a more multipolar world with geopolitical tensions, continuing trade tensions, they're just going to be part of the outlook. Obviously, if Biden were to win the election, there is a chance of a somewhat more friendly rhetoric from the U.S., but we think either president will probably continue to, have a fairly aggressive stance with China. So I think it's something that is going to weaken global growth in coming years, and at the margin, it will be inflationary given the deglobalization moves.
Nicola, this is what we're asking on our MLive blog. Are markets underpricing a pandemic impact? Do you think that fixed income is underpricing it?
Well, I think when it comes to fixed income, I think monetary policy is set to remain extremely expansionary for a very long time. I mean, we view central banks as essentially trapped. I mean, in the near term, there is the disinflation impulse of the crisis. Demand is very weak, so central banks have to stimulate. And eventually, even as the economy normalizes, the crisis is going to leave a lot of debt on the table, both public debt and private debt. And to aid the deleveraging, we think that central banks will be forced to keep interest rates low and will probably eventually have a higher tolerance for inflation, even as and when inflation were to eventually rise. We think that there will be, more tolerance than in the past. And I think the Fed actions recently tend to confirm that.
Nicola, where do you see the best value, or where do you see the biggest opportunities in sovereign credit?
When it comes to sovereign credit, look, we think interest rates are anchored, they're range-bound. Obviously, there is not a huge amount of value.
Okay, guys, we close position on Canadian dollar at 131.23, and we have £200 in profit. Okay, as you can see, this is where we closed. And profit £200 from 131.21 to 131.23.
$25 basis points over bonds is still a pretty decent carry with room for compression given the EU and the ECB policy responses. It's not that easy right now in markets to find that kind of spread for that level of risk. So I would say Italy is something to look at. And finally, I would say even in China, Chinese rates, as much as China is rebounding more sharply than others, we are skeptical, given the weak global environment, we're skeptical the central banks is going to be tightening policy anytime soon. So Chinese rates could also be somewhere to look at when to take exposure.
And Nicola, will Italian BTP move on, on how the government actually spends all of this money they have from the recovery fund in terms of grants and loans, or does it just depend, on European Central Bank action?
Well, I think it's, the ECB action is critical. I mean, the ECB has been essentially matching any net issuance by increasing its asset purchases, and it plans to continue to do so. We expect more